Thanks for having me. So I think the Fed minutes put in context that December really hawkish meeting. And we heard from the Fed that actually the last cycle normalization path, whether it was timing or how they went about it, that may not be the playbook for sort of, this exit. And so that the Fed could be faster, they could be sooner. And I think the market's starting to price that risk in. I would argue that a lot has been priced into the front end. We're pricing in almost 80% chance of the first hike in March. So I think the start of the hiking cycle is priced in, the first year is priced in. It's really about now the second year, the third year, and the balance sheet runoff. And the Fed is suggesting that they might be letting the balance sheet run off a lot faster than they did last cycle, which is why I think that 10-year move really has a lot more room here. So we're looking for the 10-year to continue to rise to closer to 2%.
The balance sheet runoff. So there's a lot of literature and academics and historical references for interest rate increases, not as much on the balance sheet shrinking. Yes, we can look in the last decade or so, but what should investors be prepared for here as the Fed looks to start shrinking more aggressively than last time, that $9 trillion balance sheet?
Sure. So I think balance sheet runoff, at that point, it's not just normalization, it's clear tightening. So I think what investors need to be looking at is how soon does that happen and how quickly do they phase it in? Remember, last time they phased it in over a year. So the increase in Treasury supply was gradually ramping up over the course of the year. Today, they suggested that it might be faster. So we have a lot of Treasury supply to contend with once they start balance sheet runoff. I think those interest rates and that long end can start to move higher. I would look at real rates. 10-year real rates have been extremely low, and that's one of the reasons why risk assets have loved this move, because even though rates have risen, it was all inflation linked. It wasn't real rates. If those real rates start to rise a lot, that's when interest rates start to hurt the economy. They start to hurt risk assets. I still think we're very low, but another 50 basis point higher in those 10-year long end real rates, which is much more about balance sheet runoff, because when the Fed lets the balance sheet run off, the U.S. Treasury will need to issue more treasuries. We have auctions, 3 weeks in a month. We'll need to bring in investors from other asset classes, equities being one. And that's why I think the broader market cares about balance sheet runoff, because we've got a large deficit, and then we'll have balance sheet runoff, meaning more treasuries, which will put upward pressure on long end rates and drive investors from other asset classes into treasuries. And, that's when I think it starts to filter through across broad asset classes.
What is your view, Priya, on the fundamental economy and the outlook for inflation? If we do see a big market wobble because of what the Fed is planning to do and likely to do you think they'll have much wiggle room to pull back if the market's scaring them, or will inflation force their hand?
Sure. So I'm glad you asked that, because today, and I would say since the December Fed meeting, it's all been about the Fed reaction function. But there's the economic outlook here as well. And I think the reason why the Fed has been hawkish is they're responding to high inflation. They're responding to wage inflation. Much of that over the last year or so is why the Fed has sort of shifted. Well, what about going forward? Our view is there's significant fiscal drag. Now, we see growth momentum slowing. There's also the Omicron impact. I mean, I think the market's looking through it as a temporary impact. It's absolutely having an impact in the travel industry, across the service sector. We actually think that's going to slow the Fed in terms of how quickly they can hike. And so I put your question in context of the economy. You get tighter financial conditions with the growth momentum slowing, and that gives the Fed pause to some caution, and they can slow their normalization. If the economy is able to look through Omicron and is able to handle the fiscal drag, then I think tighter financial conditions is exactly what the Fed wants. So I think it will depend. We have a key data report coming out, tomorrow with ISM services. We have payrolls. Might be too early to see the impact in payrolls. Another few months of the labor data, I think, is going to be important, whether the Fed will be comfortable with the tighter financial conditions which come from normalization. Do they think the economy can handle it? I think we're not entirely, we don't have that much comfort that the economy will be able to handle a significant tightening in financial conditions, given the amount of fiscal contraction that is happening. A lot of that fiscal support over the last couple of years has stopped. And so that's why our view is that actually the Fed will end up they're sounding really hawkish. They're trying to control inflation expectations. But when it comes down to actual steps, we actually think they'll be more cautious in that exit, because they don't want to tighten conditions too fast and derail the recovery.